Good morning. It's great to be with you again. September was another busy month. With the Fed's rate cuts and the unexpected Chinese stimulus, a lot happened, a lot of moving pieces and parts, and I'll take you through everything that happened and how that's impacted our views. Today, we also have a guest speaker, Bella, who will be taking you through our global 1200 equity ETF, which is the perfect starting point for any global equity portfolio. It's well diversified and low cost, and definitely something you should consider as a starting point for any global equity portfolio. But first, let's have a look at what the markets did in September. So September is traditionally, or historically at least, quite a poor month on a relative basis. And we were quite concerned, if you remember last month, that the Fed would only cut 25 basis points and the market as a result would have a poor month. And so we reduced our overweight from a large overweight to a small overweight. And that's pretty much how it started off. First week of September, the markets fell off quite aggressively as they priced in only a 25-point or a quarter percentage point cut by the Fed on some strong data that came through. We fortunately used that opportunity, that pullback in the markets, to take our overweight from a small overweight back to a large overweight. And that worked out really well because we had two big positive surprises during the month. Firstly, the Fed cut by 50 basis points, which we definitely didn't expect, and that propelled markets, the dollar lower, US bonds lower, and equities higher. And then towards the end of the month, even more unexpected, China announced a bazooka of monetary stimulus, and that led to huge and rapid movements up in commodity prices, which impacted South African resources and the rand and South African equity market as a result. So a busy month. You can see if you look at the chart, China certainly the standout performer, up 16.9% in rand terms. And then in second place, SA equities, third place, SA bonds, and fourth place, emerging markets. So the big moves definitely not Fed driven, all driven by China. If you look at world equities, down minus 2.6%, they actually were up in dollar terms, but because the rand strengthened nearly 4%, you can see there the bottom chart bar, minus 3.7, the rand strengthened against the dollar, so the dollar lost. If you had dollars, you lost 3.7% in rand terms, and that made all the global equity performances and global bond performances look negative. Well, in rand terms, they were negative. All roughly the same, around 2.5% down. Healthcare had quite a negative month. Healthcare is a more defensive asset class or sector, and people were using that to position for potential recession in the US. And with the strong data that we had towards the end of the month, plus China possibly stimulating the entire world, that didn't do as well as other asset classes. But all in all, a very strong month with two very strong drivers, the Fed pumping in lots of liquidity into the US and China pumping a lot of monetary stimulus into their economy. And I'll take you through both in a lot of detail. But so looking at our funds, the funds reflected what happened in the underlying markets. You can see there the Sygnia New China Sectors ETF up 15% for the month, a great month. Followed by SA Property, and then 3 SA Equities, Top 40 Unit Trust, Top 40 ETF, and finally the Divi Fund. So some strong SA Equity performance driven by resources, which rallied on the back of China. Property still doing well on the back of lower interest rates globally. And then if you look at the 12-month period, similar story with property at number one with 51% return. I mean, that's just an incredible one-year return from our property sector, certainly bouncing off extremely oversold levels. But then some also incredible performance from bonds, 27% from Enhanced All Bond Fund, 26% from the All Bond Fund. Just amazing 12-month returns all around, all driven by the fact the Fed has started to cut interest rates. So the Fed cut interest rates by 50 basis points. Market was obviously preparing for that sometime in advance, and as a result, bond yields came down in the US, and the dollar weakened, which allowed the rand to strengthen and allowed SA bond yields to fall, and that helped all our interest rate sensitive markets. So the question is, the big question, I mean, as you can see, a lot of this, besides China, a lot of this is driven by the global monetary cycle, by when the Fed cuts and how much the Fed cuts by. Why? Well, because firstly, the dollar is the reserve currency of the world, but also because most of the rest of the world is in floating exchange rates, and because interest rate differentials determine currency flows, a lot of central banks, to protect their inflation, try and protect their currency, and to protect their currency, they keep the interest rate differential relatively stable with the US. So when the US cuts, well, South Africa can cut. When the US hikes, South Africa has to hike. And the world is linked through this exchange rate mechanism and interest rate mechanism. So it's very important what the Fed does. And that's why we focus so much on it. So the question is, now we're in a new regime. The Fed has started to cut rates. We're now in an interest rate cutting regime. And the question is, should we not be rotating out of large caps into small caps and out of global equity into global property? As you know, we are underweight small caps and we're underweight global property and South African property for that matter. And the theory goes that when an interest rate cycle starts to move into place, that over the next 6 to 9 months, the interest rate sensitive stocks and asset classes tend to do well. And that's often property, because property is highly geared. They all have at least half of the property that they hold is bought against debt. And small caps, generally, they have less diversified funding, so they struggle to get funding from banks. So they have less diversified revenue sources, so they struggle to get funding from banks. And as a result, most of their funding is linked to interest rates. So just like you and I, when we have a home loan, as interest rates go up and down, it impacts us directly. Small companies, it's the same thing. But large caps, they manage to negotiate a 30-year loan, or they raise bonds in the market because they're bigger, and they are a lot less sensitive to interest rates. So anyway, the bottom line is that when interest rates start to fall, you expect property and small caps to start to rally, at least on a relative basis. However, I think this time is different, and the chart on the right really is quite spectacular. So it shows the percentage of companies in the US that are unprofitable. And it breaks it down into the size of the company. So the green line is the bottom third of the Russell 3000. So that's shares 2,000 to 3,000, which is generally seen as the small caps, the bottom third of the US market. And you can see there that right now, 55% of those companies are unprofitable. And you go back to 1995, and you can see that it starts off as low as 10%. So there's been a very gradual but consistent lowering in quality of small caps in the US. And the line below that, the purple line shows, or pinky purple line, shows a similar story for the next 1,000. So that's basically in the middle, from 1,000 to stocks 2,000. And that's also risen from below 10% unprofitable to nearly 40% of those being unprofitable. And I think a lot of that has to do with the COVID cycle that we went through. Obviously, as you can see in the chart, it's something that's been happening over time. The quality of mid-cap and small caps in the US has certainly degraded over time. But I think it got worse in COVID, when we had zero interest rates, and a lot of companies that should have gone bang, that should have just been allowed to disappear, were kept going. There was a lot of stimulus, interest rates were zero, and so these zombie companies were allowed to keep going. And right now, with interest rates back to more normalized levels, those zombie companies are struggling to cover their costs and are most likely going to go under. So that makes quite a strong structural change from where small caps were in the 2000s compared to where they are now, where they've gotten nearly twice as many unprofitable compared to the previous decade. And so we do think that avoiding small caps is something that we're going to continue to do. Goldman Sachs put out some research where they show that over the following 3 months and 12 months following the first rate cut, that over that period, the best performer is mid caps, so that's normally the 500 down to 1,000. So that's your black line there. So that sector of the economy and the stock market does the best over a 3-month period following the first rate cut and a 12-month period. Large caps, that's the bottom line, and you can see that under 10% are unprofitable for your top 500. They do second best. And then coming in quite far down below the small caps, with nearly a third of the return that mid caps have over the following 3 and 12 months. So we continue to avoid the small caps, although we do like the mid caps, and I'll tell you how we're positioning for that when we get to the US. The other big asset class is property. Property, as I said, highly interest rate sensitive, a lot of debt on the balance sheet. Because of the long-term nature of assets, the debt tends to be, a lot of it tends to be fixed. So they're not as geared to short-term rates, but they certainly are geared to the overall bond yield curve. The thing is about property is that it's still experiencing a lot of structural headwinds. So if you look at the commercial real estate sector in the US, which has been a problem for quite some time, it's office space in particular, delinquency rates continue to rise, and in August they rose even further. But not only that, it seems that the stress in the property market in the US is spreading beyond commercial real estate. And now we're seeing that stress starting to feature in the residential real estate market, where the multifamily sector is grappling with excess supply. And the way we can see that is the apartment list vacancy rate, which has surged from 3.8% to 6.7%. So a much larger problem starting to brew in the US. We don't think it's going to cause a recession or lead to any sort of systemic issues, but that we continue to underweight the sector. And it's driven by three structural forces. The one is remote working, which is not going away. Yes, it might be a lot less than it was, but it's still in place. A big one is green building requirements. So that's the cost of having to refurbish old brown buildings to make them meet emission standards, and that comes at a big cost. And then thirdly, the rise of online shopping has also changed the way that people spend. Distribution centers and warehouses and retail floor space all changing. So these three big structural changes continue to be headwinds for the property sector, and so we remain underweight both small caps and property, despite those both being more interest rate sensitive and traditionally should actually benefit from a rate cutting cycle. Okay, so that's the chart of the month. Let's move on to the US.
Better by that much. Assuming they're not just like politics, economy for a bit, or they're like
I love Trump. So pretty much everyone was happy with the 50 basis point rate cut. Certainly anybody with any sort of debt was happy they were paying less. Markets rallied hugely. Trump wasn't happy. He said that the Fed was just playing politics, and they should only have cut 50 basis points if the economy was really, really bad. And we certainly don't think the Fed is bad. Fed Chair Jeremy Powell said, the decision to cut 50 basis points reflects our growing confidence that strength in the labor market can be maintained in a context of moderate growth and inflation moving sustainably down to 2%. So basically, the Fed is no longer worried about inflation. They think inflation is under control. They are starting to worry about employment, which is the dual mandate that the Fed has. And so they are, as a result, to protect employment, they cut 50 basis points. The market is still a bit concerned about a recession in the US. So the Fed did lower their dot plots, so that we're now forecasting 2 rate cuts this year and then 4 next year for a cumulative 6/4 percentage point rate cuts over the next 15 months. The market's pricing in 8. So there is still some concern that the US is weak. And it's understandable. I mean, risks definitely remain. Not only global and geopolitical risks, but if you look specifically at the US, household saving rates have neared a 16-year low. And short-term interest rates, real interest rates, are at a 15-year high. Not only that, but job creation and wage growth are weakening, and fiscal policy, which has been a huge stimulus over the last 4 or 5 years since COVID, is now turning to restraint. So it's understandable why people are concerned about a recession in the US. However, we think that the US is still robust. So the big data point that came out last week was that the savings ratio, which everyone was very worried about, basically saying the US consumer is finished. The US consumer has spent all their surplus COVID savings, and so they've run out of extra savings from COVID, and now they've dipped into their savings rate so that their savings is the lowest it's been in 2 decades. And then last week, data came out to say, oops, sorry, we got it wrong. The savings rate is not actually 2.9, it's 4.9, which is a lot more reasonable, and does mean that the US actually consumer can start to spend more, and that they're not really is stretched so far on their savings rate. But not only that, and there are a lot of other positive signals. Household wealth has significantly increased in the US because of rising house values, and as we can all see, rising financial markets with S&P 500 up very strongly. But also structurally, the US consumer has reduced their household debt. So since the great financial crisis, they all learned, people got burnt, and they reduced their household debt quite substantially over the last nearly 15 years. And so that means, if you look at the charts on the right, that the debt service ratio, even with interest rates as high as they are, because of much lower debt levels, we look at the purple line, which shows the debt to disposable income, and the green line, which is the debt service ratio. Both of those are at normalized and manageable levels. So the US consumer can take on more debt. The US consumer can reduce the amount that they're saving, and they are likely to keep on spending. Not only that, but banks are becoming more and more willing to lend to the consumers. So credit is expanding alongside with bank loan growth. So while there are certainly risks, and while the fact that a lot of people do think the US is going into recession, even in the next 3 months, we think the US consumer is quite robust. Not only that, but if you look at the Atlanta Fed's GDP Now model, that forecasts GDP growth for 3Q. That's what we've just ended yesterday at 2.9%, which is certainly a decent GDP growth. And more worryingly, they are seeing upside risks to the PCE, which is the inflation that the Fed follows. And they see that running real time at 3%. So there actually might be as much chance that inflation picks up and the Fed can't cut anymore as there is a chance that the US consumer falls into recession. So, we are equally worried about both risks, upside risks and downside risks. But for now, we're sitting in the Goldilocks and overweight US equities and overweight the US as for the moment, inflation is under control and growth remains robust. So the US is still good. The Fed, Jeremy Powell came out last night to say that we mustn't get ahead of ourselves and don't expect any more 50 basis point cuts, 25 points. I think this is also more realistic, and the market might start pricing in some more fewer rate cuts over the next 15 months. And I think as that happens, the markets might come off a little bit. We had a really strong September. We still are overweight equities. We have a large overweight equities, but we'll be watching that quite closely to see if a lot of the upside has been priced in, and we need to start to trim that position. Okay, so the big news for the month was China. China unveiled a bazooka, and I'm using the word bazooka because it certainly is the biggest stimulus they've done so far, and it was the most forceful in terms of everybody coming out, various departments, including Xi Jinping, to say that they can't afford growth to slip any further, and they are going to focus on stimulating the economy. So here we have Pan Gongsheng, governor of People's Bank of China, and he said that the Bank of China is going to inject $1 trillion, or about $140 billion into the economy through long-term liquidity, and that's by cutting the bank's reserve requirement ratio to the lowest it's been since 2018. So yes, a lot happened and a lot was promised. So let's look at what they did. Firstly, they cut interest rates a lot more than was expected. They cut the bank's reserve ratio, as I said. Mortgage rates were lowered substantially, and rules for second home purchases were also eased. And I think even more importantly, the government's been trying to encourage municipalities and local governments to buy the excess properties that are out there and convert them into low-cost housing. Up till now, they were only guaranteeing 60% of that purchase price. Now they're guaranteeing 100%. So it's much more likely that the municipalities will start buying excess property and converting it. If they make money, well, that's good for them. If they don't make money, well, the government's guaranteeing all of it, and so any losses will get shored up, and so there's really no downside, and so they'll probably step into that. They also announced a stock stabilization fund of 500 billion yuan to mop up excess liquidity and try and drive growth in the stock market in China. So that's all very, very exciting. The thing is it enough? And And is it the right sort of stimulus? As you can see, every one of those pieces of stimulus is monetary stimulus. And it's almost like pushing on a piece of lead with a string and hoping that something happens. You can lower the cost of money as much as you want to. You can't force people to borrow. So it's the demand side that needs to be fixed. And the issue in China is there's a lack of consumer confidence, and that's resulting in a lack of demand. And it doesn't matter how cheap they make the debt or how much monetary stimulus is put in place, they need to create consumer confidence. So where should China sitting right now? China's really in a deflationary downward spiral. Inflation is at a 3-year low. If you look at the Chinese economic and inflation surprise index, it's more negative than in any time since the great financial crisis of 2008, 2009. We're seeing housing starts are down 75%. Housing prices have fallen for 4 years in a row. And not only that, but the United Nations projects a 70% decrease in China's working age population by the end of the century. So China's not only got the headwinds from a property bubble, which burst, it's got an aging population, and it just hasn't got enough drive to get the consumer to spend. And this is reflected on the chart on the right, which shows that China has the highest level of savings amongst major economies. I mean, it's huge. It's, you know, it's more than 50% higher than Japan, which is second. And that just shows that the Chinese consumer doesn't want to spend. They just want to save. And when there is no spending in the economy, that's when the government needs to step in and spend, counter-cyclical spend, fiscal spend, to get the economy up and going, so that the people get jobs and people make money in the stock market and their houses, and they feel wealthy and they want to spend more. But China hasn't been doing that. Up till now, they've been concerned that they have too much debt, but they actually don't have too much debt. They don't have enough debt. They've got too much savings. So their debt is easily covered by the excess savings in the economy, as shown in the chart. And they need to not just cut monetary or have monetary stimulus. They need to take on a bit more debt and drive spend. So what we do have is the Politburo pledge to issue 2 trillion yuan of special sovereign bonds as part of a fiscal stimulus. They didn't say when, and they didn't say what it's going to be used for. So I think the market is waiting for a bit more certainty. Certainly, I am waiting for more certainty. So we have the National People's Congress, NPC, the Standing Committee meeting on the 6th of October. And we'll wait and see what comes out of that. If there's substantial fiscal stimulus that can drive consumer confidence, and lead to increased consumer spending in China, well, then maybe this is the bazooka we're waiting for. But if it's just piecemeal, dotted fiscal stimulus, then they just aren't doing enough. So certainly the biggest stimulus that we've seen since COVID in China, definitely a step in the right direction. Certainly the markets have reacted incredibly well. A lot of that is assumed to be people covering shorts, and as opposed to people actually going fundamentally long on China. And so we'll have to wait and see. But it really comes down to, it's not the right sort of stimulus. The government needs to take on more debt, not reduce its debt. And we'll see how willing they are to do that on the 6th of October. But for now, we remain underweight China. We remain underweight emerging markets, neutral South Africa. And we'll see, we're watching this very closely to see what happens. Okay, moving on to South Africa. Our governor of the South African Reserve Bank continues to be very conservative and very hawkish. So we did, the MPC met, and you can see here in the statement, in discussing the stance, MPC members considered an unchanged stance, a 25 basis point cut, and a 50 basis point cut. The MPC ultimately reached consensus on 25 basis points. So this certainly was very surprising as well. I mean, when we expected the Fed to do 25, well, we thought that South Africa would do 25. But the fact that the Fed did 50, when the Fed's inflation is 3% and it targets 2%, and our core inflation is below our target, and the Fed's got real rates of 1% and we've got real rates of 4%, well, I thought we could easily match that 50 basis points and try and stimulate our economy with low interest rates. But the SARB Monetary Policy Committee decided to not do that. They remain hawkish, they remain conservative, and they only cut 25 basis points. So yay, it was a cut, but I think we still have a long way to go. We still have incredibly high real rates, and that's understandable to some extent because there are a lot of risks in South Africa, but hopefully the longer the government of nationality stays in place, the risk premium that's priced in South Africa will reduce, and we'll be allowed to lower our real rates without our currencies spiraling out of control. So some good news on the horizon, but we remain neutral still on South Africa. So a very interesting piece of research from Professor Haroon Borat, who sits on our investment committee, and he looks at some research that the National Treasury and the University of Helsinki did in South Africa. So it's some economic research. It talks about the Laffer curve. So what is the Laffer curve? The Laffer curve suggests a U-shape relationship between tax rates and government revenue. Basically, when you first increase taxes, people are willing to pay because they know the government needs taxes and they know that they're getting something back for it. But at some point, that tax rate, that curve turns over, and despite the tax rate going up, the government actually earns less money because people try and avoid the tax because they feel that it's unfair. They don't feel that that they're getting their revenues worth in return. So chart on the right is certainly interesting. South Africa's economy has one of the highest marginal personal income tax rates in the world. You can see there the green dot at 45%. That's our highest level marginal tax rate, personal income tax rate, and compare that to GDP per capita on the x-axis. You can see therefore the very, very small amount of GDP per capita that each of us earn. We are certainly a very poor country on that basis. We have the highest personal income tax rate out of all of those countries. So we are, and I think we all agree, we feel it, we are overtaxed, and we don't feel like we're getting enough from our tax revenues in return. So, but that's just a feeling. So the National Treasury and University of Helsinki put some economic measurements into that, and they looked at the 2017 personal income tax hike from 41%. Remember the good old days when you only paid 41% personal income tax marginal rate to 45%, and they looked at the impact. And the research shows that increase from 41% to 45% did not raise tax revenues. In fact, it moved South Africa to the wrong side of the Laffer curve, and individuals either worked less or switched jurisdictions or evaded taxes, and the tax revenue received in that bracket actually fell. So, yeah, not good not effective from a tax revenue perspective, but it gets worse. The research also showed that companies linked to those high income earners showed a significant drop in output after the tax hike. So not only was the government earning less, but people who were paying the higher tax just said, well, listen, why should I work so hard? The government's getting most of my money. I'd rather just take an extra sick day. And output dropped in those companies. So the research clearly shows that our personal income tax rates should not go any higher. In fact, they should be lowered. We can all pray and hope that they get lowered. I can't see that happening because we really don't have enough tax revenues to cover our huge social spending. But at least we can hope that based on this research that personal income tax levels aren't raised any higher, or alternatively, we realized that things like NHI, which would be another type of personal income tax, aren't affordable, and that it would just lead to lower revenues being achieved by SARS. So some very interesting research into South Africa. As I said, from an overall South Africa perspective, SA assets did incredibly well this month, driven very much by resources. We are a small open economy. I've always said it. Sometimes we do incredibly well despite ourselves. Sometimes we do poorly despite ourselves, because depending on the price of the commodities that we export, assuming we can get them to the ports, that impacts our export revenues, which will impact our currency and our tax revenues and our whole economy, really. So some very strong performance this month in our markets on the back of the China stimulus and what that hopefully can do to commodity prices. Now, the interesting thing is, if you delve deeper into what China is doing so far, monetary policy stimulus doesn't impact demand at all. It doesn't fix the property sector. It doesn't mean people are going to start building new properties in China. It doesn't mean people are going to spend. If they do spend, they might buy another toaster. They're not going to buy a second home based on what has been announced so far. So that then you look at the impact on the kind of commodities that supports, and steel and iron ore and other things shouldn't have rallied, and yet they did rally. So it was very much everything went up, and we'll be watching for a much more specific moves going forward as directly linked to the stimulus that happens within China. As I said, the stimulus, fiscal stimulus will be announced on 6th of October, so we'll see what happens. China's on their week-long holiday from today, and we'll be, so there won't be much news out of China, and we'll see what happens when they get back from holiday and what happens. But if that news disappoints, it's likely that commodity prices could roll over and resources could fall back, and South African assets could do a little bit poorly. The big risk we have next month is also the medium-term budget policy statement, so we are waiting for that to see what news that has. Certainly anecdotally, looking at two pots, less money has been pulled out than was expected, so that might drive GDP less than expected. And more of that money that was pulled out has gone to SARS than to the consumer than was expected. So that might help the budget a little bit more, although it's pretty insignificant compared to our budget, our revenue deficit. So nothing too positive. The only thing that could happen is commodity prices could stay elevated, and obviously that leads to windfall revenues. So we'll wait and see what happens to that. But for now, neutral South Africa equities and neutral South African bonds. Okay, so let's sum it up and wrap up with our positioning. The other important numbers that came out this month were the S&P Global Flash PMIs. That's your best forward-looking estimate on the two parts of the economy, your service economy and your manufacturing economy, across all jurisdictions. So it's a great forward-looking, almost real-time barometer. And the flash PMI showed that the contraction in manufacturing accelerated, got worse in August. But fortunately, service PMIs continued to expand in all regions. So more of this divergence with manufacturing falling further into contraction, services accelerating or moving sideways. So if we dig into that, what does it mean? Well, the weakness in manufacturing in Europe seems to be very much linked to China and the fact that China continues to languish, or at least it did until the stimulus. And also Europe continues to be held back by high energy prices, which, although they've come back, they still aren't as low as they were before. The weakness in manufacturing in the US seems to be very much COVID related. When the huge amount that was spent on goods and products during COVID still hasn't normalized, even though we've been out of lockdown for a few years now, and so that demand is artificially depressed by that COVID starting point. But what does it mean? When we look at the overall global economy, it means that those countries that have more services and a bigger consumer spend will continue to do well relatively to those kind of economies and countries that are more manufacturing related. And the US is certainly the biggest consumer in the world. The US consumer makes up for 69% of US GDP. It's amazing. I mean, it's a consumption-based economy. The US is seen as the global consumer of last resort. And the rest of the world basically makes goods for the US. The rest of the world, whether it's Europe or Japan or emerging markets, all part of a global product supply chain that exports indirectly or directly to the US. And while manufacturing is depressed, it means that those economies, Japan, Europe, emerging markets, are going to struggle to compete with, as well as the US. Not only that, but the US actually benefits because the consumer benefits from product deflation. So when you've got Europe and Japan and China all fighting for the US consumer, they keep lowering their prices. So they're exporting deflation, the consumer gets cheap products, so the consumer benefits, and those countries get thinner and thinner margins, and so there's less and less profitability coming through from the rest of the world. And that also feeds through to commodity prices, and everything struggles as a result. So this month we've seen, on the back of a weak dollar and on the back of China stimulus, we've seen strong EMs. We've seen strong commodity prices, strong resource rallies, strong price movements in Europe, Japan, and emerging markets. Everything that is the opposite of our positioning. But we don't think that this is going to stay the case. We do think that China is not going to, our base case, anyway, we can change our view next month, but our base case is that China is not doing enough to stimulate its economy, that there's a structural issue with their consumer confidence, and that as a result of the lack of spend, because remember, China creates 30% of the world's goods, but only consumes 15%. So as long as that imbalance remains, there's going to be an excess supply of goods, and the manufacturing part of the world, Europe, South Africa, emerging markets, Japan, China, is all going to continue to trundle along, and the US with their robust consumer is going to continue to benefit. So that speaks to our overall positioning of why we remain overweight the US, despite the price action we saw in August, and that is our base case. Now, we also remain overweight equities, and you might say, well, why aren't you concerned about the fact that markets have run so strongly? And yes, markets have run really strongly, but the chart on the right gives us confidence that they have further to go. So it's a great chart. It's from Alpine Macro. It goes back to 1974, and it breaks the 9 recessions down into those recessions that were followed by those. Sorry, it breaks the 9 rate cutting cycles down into those that were followed by a recession in the following 12 months, which is the purple blue line, and those that didn't have recession in the following 12 months, and that's the green line. So you can see there are 4 times in the last 50 years where the US started to cut rates, and over the next 12 months, there wasn't a recession. And of those 4 times, the median return was 18% from the S&P 500. Of course, when there was a recession, that which is the other 5 of 9 times, well, the median return was about -10. So it's very important to know whether there's a recession coming over the next 12 months or not, clearly. But from what we can see, it doesn't look like there's a recession coming in the next 12 months. And so we remain overweight equities and overweight the US. But obviously, we monitor the data on a continual basis to see if that changes. Not only that, but there are a lot of risks. Geopolitical risks haven't gone away. You might look at the month of September's or even year-to-date returns, which are sitting at nearly 20%, and say, well, clearly there are no risks in the world, but risks are there, and they continue to escalate. In fact, shipping costs remain elevated. They're down from their highs, but they are much higher than the normalized levels. And geopolitical risk continues to rise. Certainly, things in Israel are getting hotter and hotter and hotter, and there's a very, very big chance that might hit a tipping point sometime soon and escalate into full-blown war if Iran feels that they have to step in. Not only that, but there's also a growing likelihood that the US and UK might grant Ukraine the license to fire US and UK supplied long-range missiles directly into Russia. And that could escalate the Russia-Ukraine war. And then, of course, there's the US elections on the 5th of November. So that's coming closer and closer. And as we're closer to that point, so volatility is going to move the US market. So a lot of risk around, some big events happening over the next 6 weeks. We are staying long equities into these risk events, but we are nervous, obviously. Markets have run strongly. We've got geopolitical risks. We've got US elections. And so we're going to be watching it quite closely to see if we need to make any changes as we move closer and closer to the end of the year. And that's where we are. It's a wrap. Let's have a look at the Sygnia SYG ESG ETF. Over to Bella.
Good morning, everyone. I'm thrilled to be touching on the S&P Global 1200 ESG Index and why we have chosen to track its performance. The S&P Global 1200 ESG Index is a broad-based market cap-weighted index that tracks the performance of companies that meet certain sustainability standards. The key here is that while the index promotes sustainability, it also aims to maintain the industry group weightings of the broader S&P Global 1200 index, ensuring consistency across sectors. The index consists of companies that are already part of the S&P Global 1200, but exclude certain industries. These exclusions include tobacco, thermal coal, controversial weapons, and those that don't comply with the United Nations Global Compact principles. Also, what makes this index appealing is its performance. As can be seen by the chart on the right, both indices have maintained similar cumulative returns over a 5-year period, where the S&P Global 1200 ESG Index has a 0.8% 5-year annualized tracking error to the S&P Global 1200. This means it remains closely aligned with the broader index. Additionally, the ESG Aligned Index actually outperforms by 0.6% per annum over a 5-year period. So not only are you gaining access to a well-diversified global portfolio of companies, but you have the added benefit of investing sustainably. The Sygnia MSCI World ETF has a 16-year track record of performance, investing in an index that provides exposure to global equities in developed markets. Building on this experience, we introduced the Sygnia Global 1200 ESG ETF to offer investors a more forward-thinking option at a lower cost. In addition to being ESG cognizant, our Global 1200 ESG ETF maintains a similar global allocation to our MSCI World ETF. However, it also includes a small portion of its allocation in emerging markets, gaining exposure to some of the emerging market global giants such as Taiwan Semiconductor, as can be seen in the regional allocation table on the right. As you can see from the performance table, our Global 1200 ESG fund has similar performance figures to our MSCI World Fund and outperforms our largest competitor's equivalent ETF over 3 years, while being slightly behind over 1 year. However, total return is just one aspect when comparing ETFs. The spread required to buy and sell ETFs can have a huge impact on performance. The bid-offer chart below contains spreads taken over a 1-week period from opening to close of the market each day. It can be seen that our spreads are much tighter, varying from 0.1% to 0.7%, while our competitor spreads vary from 0.1% with a sharp rise beyond 1%. A spread of 1% or higher when entering and exiting the market can significantly erode your total return, as these transaction costs directly impact the performance of your portfolio. All of this highlights how our Global 1200 ESG ETF provides an excellent balance between sustainability and strong performance, offering a competitive option for investors seeking offshore exposure. And all of this comes at the remarkably low fee of only 30 basis points. Thank you.
Great. Thank you, Bella. That is awesome. So that's our SYG. The code on the JSE is SYG ESG. So we have SYG ESG and we have SYG WD, SYG World, 2 globally diversified equity ETFs. Yeah, have a look at both of those when you are looking for a global equity ETF. I'm a big fan of the SYG ESG fund. And just to reiterate, although the code is SYG ESG, it is basically the S&P 1200 global index, just with that very small ESG cognizant overlay. Okay, let's move to questions and answers. Okay, first question. Barbara says, and she's got 4 questions there, so I'm going to do one at a time. Is resources going to make a comeback? Barbara, that's a great question. It all depends on exactly what China does in terms of their stimulus and how they stimulate the economy. Right now, I don't see resources making a comeback. Right now, with just monetary stimulus that's been announced in China, as I said, it's just a string pushing on a lead weight. You can't force people to buy second homes. You can't force people to renovate. You can't force people to spend. And so without that demand, it's unlikely that we're going to see a huge demand for commodities. Because remember, although we are positive on the US is still slowing. So you've got a slowing US, and the US is a consumer of last resort. So as the US slows, there's actually a risk that the rest of the world goes into recession because they can't export as much to the US. So yes, it depends on what China does, but right now our base case is resources are going to continue to muddle along. Is the ACWI a good investment at the moment? So the ACWI is the All Country World Index. So we have, so the Sygnia MSCI World ETF is MSCI World. That's developed market only. It has 0% emerging markets. Sig ESG, that's the Sygnia S&P 1200 Global Equity ETF, that has 3% emerging markets. So those are the two we offer. ACWI, which is the MSCI All Country World Index, that has 10% emerging markets. So it all depends on how much emerging market exposure you want. If you want ACWI, well, then you can buy 10% in the Sygnia Emerging Markets 50 ETF and 90% in the Sig World, or 7% in the Sygnia EM 50 ETF and 93%, or whatever the maths is, in the Sig ESG fund. You can create that balance yourself. But the MSCI or the S&P World indices are always a great place to start. They are your most diversified portfolio. They generally are your lowest cost portfolios. And then you can add a little bit of emerging markets in if you want to. Barbara's third question: which Sygnia fund focuses on mid and small cap shares? So we don't have funds which focus on small cap shares at the moment. As you know, we are not big fans of small caps at the moment. We have shifted our focus. And sorry, I should have mentioned this on the US chart. We have shifted our focus away from the large caps and more to the mid caps. And when I say mid caps, I just actually mean excluding the Magnificent Seven. So we've downweighted our exposure to FANG, which I've said before, and we have restructured the Fourth Industrial Revolution Fund so that it has, we've capping the exposure to the big companies and expanding the tail of mid caps, so there's more mid cap exposure in the fourth IR. And remember now, the fourth IR unit trust and the fourth IR ETF have identical exposures, or almost identical exposures, and so you can get exposure to US, to a slightly more mid-cap version than the overall tech exposure, and you can get that through those two funds. And then Barbara's fourth question: what alternative should one use for tech stocks? Well, if you want to avoid tech stocks, then you can look at any other geography, because tech is highest in the US, and other like Europe and Japan have a lot smaller tech exposures. Or you can look at something like the Berkshire Hathaway fund, which also got a lot less tech, with Berkshire selling down their Apple exposure quite significantly. Okay. Mervyn says, is the S&P Kensho New Economies Index still a good reflection on the performance of the Sygnia Fourth Industrial Revolution actively managed ETF, or would the NASDAQ be a better measure of performance? Certainly right now, Mervyn, well, so about a year ago, in September last year, we switched our unit trust, the Fourth Industrial Revolution unit trust, from an equally weighted portfolio construction basis to a market cap weighted. And that means it looked, from a year, for the last year, it's looked less like Kensho and more like NASDAQ. And then more recently, we've just made that change to the actively managed ETF, because we bought the actively managed ETF in line with the unit trust. And you can see that over the last 12 months, that's worked very nicely for the unit trust. We wish we could have done it to the ETF sooner, but we had to wait for the whole ballot process to convert that ETF. So right now, identical exposure in both unit trust and ETF, and it is market cap weighted, but we have capped that cap at 7%. So it's a lower cap than the index, just to try and get a bit more mid-cap exposure. Wayne says, do you see the dollar strengthening against the ZAR post-US elections? So Wayne, that's the ultimate question we wish we all knew the answer to when it comes to forecasting the rand. It's difficult. As I've said before, the rand strengthened significantly in September, primarily as a result of strong resources. So commodity prices do impact the rand. It's also, the rand has rallied in August on the back of the potential for Fed cuts, and now we're seeing Fed cuts. So a weaker dollar obviously helps the rand. It's the rand dollar. So you've got both the rand, the Fed cuts and commodity prices helping. However, I don't think the Fed's going to be able to cut as much as the market's pricing in. As I said, market's pricing at 8 cuts. I think the Fed's going to start to worry about inflation at some point. And I think China hasn't done enough. So I don't think the rand's going to strengthen from these levels. In fact, I think it could weaken slightly. You're sitting around 17, got to a low of 17. It's now back up at 17 and a quarter. And we could see some volatility. It also depends on what happens at the US elections. Yeah, I don't actually see a good outcome from the US elections, and we'll have to review our positioning at that point. If Harris wins, it's probably better for the rest of the world and not as good for the US, because tax rates, corporate tax rates will be raised in the US, which is, you know, direct negative impact on earnings. But we aren't likely to see as aggressive actions towards the rest of the world. So the rest of the world growth might survive it better. If Trump wins, well, then tax rates are probably going to go even lower, which will be even better for US equities. But the rest of the world won't do as well because Trump will be quite aggressive in terms of those foreign diplomatic relationships. So we are positioned at the moment for a Trump victory, and it's just not because of we expect Trump to win, because it's 50-50 because of the way the economy is working out, and we'd have to change that positioning slightly if Harris does win. So we are going to watch that quite closely. I do think it's too close to call, and we'll have to see what happens. Question from Anonymous, and we have answered this before. Currently, the S&P 1200 ETF index does not have any Israeli-linked companies, or any Israeli-listed companies, should I say. And another question on that 1200 index, it's not a Sharia-compliant index. It's an ESG, a broad ESG compliant index. So yes, it does exclude tobacco, but it doesn't include, and doesn't earn interest just because it's all equities, but it's certainly not designed to be Sharia compliant. Bilalani says, is Transnet ready for the resources rally? I really hope so. We'll see. Sean says, why doesn't the Sygnia S&P 500 ETF track the S&P 500 directly? Sean, it does. So the Sygnia S&P 500 ETF is a rand-based ETF. So if you convert S&P 500 from dollars into rands, it does track it directly on a price basis, not total return, because it pays out dividends. So if you adjust for dividends and you adjust for the currency, it does track it. It's something that we will monitor very closely, and I promise that tracking error is a couple of basis points. It is incredibly well managed. Vinod asks, what is the latest outlook for AI stocks? That's a good question. We, as I said before, we did downweight our FANG exposure. And it's not that we don't think AI is going to improve productivity, but we do think that the AI stocks have pretty much priced in all the earnings upside that's going to happen, at least in the next year or two. So the markets now understand what large language models do, or generative AI. They understand that it helps you write better, it helps code better, but that's pretty much where it ends. And we haven't seen companies beyond $20 a month subscription being able to monetize that or improve their product. If anything, for the moment, it's just allowing them to compete with each other. So Google has to have AI in its search engine because Microsoft added AI to its Bing engine. So the consumer's getting a better service at no extra cost. So we again will continue to monitor that, but we have reduced our FANG overweight because we are waiting for the next driver of the next leg up. What's going to be the spark? And we have seen OpenAI talk about some models they want to release that have reasoning ability, which would be incredible. It so happens they released that announcement on the same day that they announced a big capital raise. So no surprise there, without any promises. Raising capital at a $150 billion valuation, certainly not cheap. But if they have created an AI that can reason, well, that would be certainly the next step that will drive those shares. But we'll wait and see on that one. So it's one thing just interpolating language. It's another thing creating a thinking or reasoning machine. Rowan, hi Carl, can we expect the price of gold and silver to keep increasing into 2026, and why? Rowan, I can't answer that question. I can tell you why it's going up. So the price of gold has been purely driven, and I've got some great charts that I was actually going to show today, but I took them out because of time. The price of gold has been purely driven by emerging market central banks. And you can see from the moment of Russia-Ukraine war, so emerging markets banks bought gold and they sold gold quite aggressively, and the Russia-Ukraine war started, and we had all sorts of sanctions, and from there, emerging market central bank purchases have just skyrocketed. And what's interesting is you look at the private sector holdings, so that's companies and individuals, that's fallen off dramatically. So as gold has been driven to these crazy highs by central banks, so investors are getting out of it because they don't see the value. So if you think emerging market central banks will continue to buy, well, then gold's going to keep going up, and so will silver, because silver is linked to the gold price. But if you think that they are going to be a bit more price cognizant and take a break, well, then the gold come off. A few months ago, China for 1 month stopped buying, and gold had a hugely negative reaction. So it's very much linked to the central bank purchasing outlook. And I always ask the question, why is platinum not running as well? I mean, three precious metals, gold, silver, and the platinum group metals, whether it's rhodium, palladium, platinum, those are your precious metals. They are substitutes to some extent, and platinum's gone nowhere. So the fact is that there's just strong buying demand for gold. Silver, to a long extent, actually lagged gold quite significantly because, again, central banks are just buying gold, and silver has caught up more recently. But that's on the back of the silver gold ratio is linked to the oil gold copper ratio in terms of defensive plays versus industrial plays, and that's just because growth has picked up a bit. Daniel says, how do you see the Fed's interest rate cutting cycle affecting the Fourth Industrial Revolution Fund outlook? Is there big exposure to small caps and profitable companies in the fund? Daniel, excellent question. So no, so since we changed from the Kensho process to the NASDAQ process, so it's Kensho to NASDAQ, it's just a sort of proxy. It is the Sygnia process. We have our own process, but one is more closely aligned to Kensho, one's more closely aligned to NASDAQ. But since we changed from the small cap process to the large cap process a year ago, we also put in a filter that excluded all unprofitable companies. And that's one of the reasons why that unit trust has continued to outperform the ETF and the benchmark. And over the last the ETF now that's actively managed also has the same filter. We exclude unprofitable companies because we just don't see what's going to drive it. There's one thing if you are making a loss after interest and tax, but you're making a profit, but you're profitable at an EBITDA level. So you might say, okay, fine. Well, if interest costs come down, that company is going to be profitable. But the problem is nearly 40% of small caps are loss-making at the EBITDA level. So it doesn't matter, you could take interest rates to zero, they're not going to make any money. And the market is quite aware of what happened. Shame on you, what is it? twice, and they're not going to invest in small caps until they actually see some real earnings coming through from that sector. So I don't think that small caps are going to bounce. Well, they might have a dead cat bounce, but I don't think there's any strong earnings growth coming through to drive that sector long term. And so we don't have, as I said, we're moving our exposure to mid caps in the fourth industrial revolution, not small caps. Aaron says, unfair question, but what's your view on the Rand? Initial average projections for the year clustered around mid-17s. Has that view changed? So I'm going to say again, it depends on what China does, but assuming China, my base case is China doesn't unveil anything significantly different on the 6th of October, in which case the Rand's probably going to weaken back to mid-17s. And that's partly as the market expects less Fed cutting, so the dollar strengthens a bit. And it's also just as resources fall back a bit. So yeah, I'm still in the mid-17 range for the end of the year, but all dependent on China and the US. Anton says, should I now move the funds parked in enhanced bonds? So Anton, that's also a great question. So if you look at, so we have two amazing income funds. I mean, they really are amazing. We've got the enhanced income fund, which has almost zero bond exposure and zero property exposure. That's basically just a long-term money market fund, and that performance is just incredible. It's basically money market on steroids, very little volatility, but you're getting much nicer returns than money market. And then you get the Sygnia income maximizer, and that is not afraid to have a lot of price volatility, and it's not afraid to invest in bonds. It just makes sure that it gets the highest yield. So the income maximizer is for people who they're happy to live off the income. They don't need to actually sell their capital, and so they can afford some capital volatility. That fund's done incredibly well because it was nearly 100% bonds going into this rally. We have subsequently reduced it to 30% bonds, from 100 all the way down to 30. So we still have some bonds. We still think there's reason to have some bonds, but we think a lot of the upside, for a long time we were forecasting 20% return from bonds because yields would come down, and it took a lot longer than we expected, but it's happened now. We've had the 20% return out of capital return out of bonds. It's given you nearly a 30% total return out of bonds, and so we have reduced our bond exposure in our income funds from 100 down to 30. Enhanced income, the more conservative fund, doesn't have any bonds. And that only went up to 5% when it was wanted to invest. So Anton says, where to? So in income maximizer, we switched that 70% that wasn't SA bonds. We sold that and put that into enhanced income fund. So that's basically income and credit. So Anonymous had a question. Please recap why SOB follows the Fed with hiking, cutting interest rates. Okay, so the SOB's mandate and most central banks' mandates are to keep inflation stable. They tend not to focus on growth. Growth is secondary. The Fed does look at employment, but again, the majority of central banks focus on inflation. Now, one of the key risks to inflation is the exchange rate, particularly for a small open economy like South Africa. So when the SOB talks about managing interest rates, they look at what can impact forward-looking inflation or inflation expectations, and a weaker currency leads to weaker or higher inflation expectations. So they are cognizant of what the currency can do, and so they're aware that global money follows real rates and real rate differentials, and that if you let your real rates fall too low compared to other countries, the hot money will move and invest elsewhere, and that will lead to your currency weakening. Now, this is a secondary impact. It's not something directly in the SOB model, but it is certainly something that they are cognizant of. You cannot let your interest rates lag other markets, which are, and everyone else is following the Fed. So it's pretty much a bit of a Me Too thing, that if every other central bank is following the Fed so that their interest rate differential stays relatively stable, then the whole market's playing that game and you're kind of forced to do it. There are very few economies that are big enough to ignore what the Fed's doing. European Central Bank claim that they don't care what the Fed's doing, but I think they are also cognizant. China is forced to because they peg their currency to the dollar, so they have to move with the dollar. So the whole world was on the dollar standard. Now the whole world's kind of on the US interest rate standard, just because that keeps your flexible exchange rates kind of flexible, but sort of pegged in an indirect manner, and then you have more stable monetary policy. So that's the thinking. Some of that's not in line with what your academic models say it should happen, but it's what happens in reality. Irvin says the Sygnia S&P 1200 Matrix ESG ETF. Why does it make up such a small portion of the Sygnia Global View, where you have more focus from the MSCI World Index, if I recall? So that's a great question. So moving from our perspective, they are very similar. They're almost identical. The difference is the ESG overlay, which is, as you can see, is a tiny impact on performance, and the EM difference. So as you know, we are underweight emerging markets and underweight China, and so we chose MSCI World because we didn't want that 3% EM. But it's 3% is not a huge difference. It just reflected our view better, as opposed to MSCI World, which has 0% EM, and so a better reflection. And if we ever choose to go neutral emerging markets, we can either buy the Sygnia Emerging Market ETF, or we could switch out of World into ESG. The other issue, just for complete transparency, is that we try to minimize costs as much as possible. And if two products are almost identical, there's no point in undergoing the cost of switching from one to the other and incurring the trading costs if you're getting a very similar result. And so we did hold the other one historically, and so we are avoiding switching. We are switching with cash flows where we can, but we're not aggressively switching and aggressively incurring any costs we don't want to. William, China-based companies like Alibaba, Tencent, Baidu, and JD.com seem incredibly cheap at the moment. Given the bazooka stimulus the Chinese government has embarked on, would this not be a good time to go long on these? So, William, certainly that's what the market's done. And you're right. So there was a question last month about India. I mean, India has been an incredible performer. India, over the last 5 years, is actually the best performing geography in the world, and better than the US. India currently sits on over a 30 PE, which I think for an emerging market is crazy. China, so South Africa sits on roughly a 15 PE. China sits on a 10 PE. So yes, China is very cheap. And some of these global companies, Alibaba, Tencent, Baidu, JD.com, have great business models and are very cheap. And so that is the reason people have been buying them. They're obviously less cheap now. They've rallied 20%. But the bull case for going long China is it's cheap. The bear case is that it's cheap for a reason, and that's that Xi Jinping is more concerned about a broad-based economy and consumer welfare, and will force companies to do what's ever best for other stakeholders. So make sure that consumers get the best product, make sure that staff are paid the highest salaries, and shareholders as a result will lose out on it. So that is the concern, and we don't know to what extent it will happen, but certainly since the crackdown a few years ago in China, we haven't seen shareholder returns or return on equity improve out of China. So the bear case is that the overall political environment is not conducive for aggressive shareholder returns. Return on equity is going to stay low in China, and as a result, prices are not going to re-rate, and your price to book deserves to be at a 1 or 1.5 or wherever it is. So to some extent, China then becomes a dividend play, and you can say, well, fine, I'll get my 3% dividend yield, and hopefully I get a little bit of earnings growth. But yeah, that's the debate. We don't know. Certainly, the latest amounts of stimulus are again focusing on growth. They're not focusing on shareholder returns. And there has been some noises about private sector property rights, but it's seeing is believing, and it's more noise than anything else. Thanks, Mervyn. Lilani says, is our interest rate differential sufficiently attractive? Certainly. And we have some of the highest interest rate real rates in the world, both on the long end of the bond curve and the short end. So our real interest rates are very high at the moment and attractive. And it's one of the reasons why the rand has rallied. Good question. Sean says, the slowing uptake of EVs should have a negative impact on future PGM demand for South Africa. So why should China stimulus, which is not industrial focused, drive SA commodity drive? Is this rhetoric misplaced? Your view, please. Sean, I completely agree with you. I think the fact that we've had monetary stimulus announced in China, and there's been broad-based commodity rallies from iron ore, steel, copper, platinum, gold, everything's rallying. I think that is misplaced, and I think you need to be more specific in looking at what is going to rally. And certainly, one of the reasons that PGMs have struggled is the move, the accelerated or the faster than expected move to electric vehicles, which don't have any need for rhodium or platinum or palladium. However, just on that one specific data point, there has been a reversal, and we are starting to see people shun pure EVs because they haven't quite got over their range issues, and there's been an accelerated demand just in the last few months for plug-in hybrids, and that seems to be the way forward. So certainly, if you look at what BMW are doing, what Toyota are doing, BMW is moving away from their EVs. Toyota is moving away from the hydrogen vehicles, and they're both pushing very hard the plug-in hybrids. So that's, you have a smaller petrol engine, which will need some platinum or palladium, and you have an electric engine, and the two of them work together to give you better range and better power and better fuel efficiency. So that's, right now, that seems to be the answer until battery technology changes. And so that actually could see PGMs move into a deficit over the next 12 months. But we'll have to see. There's always a risk of Russia smuggling palladium out of their country to help their revenues. So that could keep PGM markets down. Is it fair to say that the S&P 1000 or 1500 is a better proxy for mid and small caps than the Russell 3000? Certainly. I mean, I would say that the bottom 2000 of the Russell 3000 is small caps, and I'd look at S&P 500 or S&P 1000. The Russell 1000 is a better proxy for mid caps than the other two. Carl, I think I'll answer your question on bond funds. I think there could be a little bit more to come in terms of capital returns out of bonds if yields fall a little bit further in South Africa. But I think the lion's share of that is behind us. We still have significant risks. Yes, GNU is working well, and yes, commodity prices have rallied recently, and yes, the US has started a rate cutting cycle, but a lot of that has been priced in. And I think the key here is the interest differential between South Africa 10-year bonds and US 10-year bonds, and that has shrunk to quite a historic low. And I don't think US bonds have much further to go either. Bond yields could go lower either, unless there's a recession. So I think most of the capital return from bonds has happened. And if you want to hold them now, just hold them for a yield return. Okay, that is it for the Q&A. Thank you, everybody, for joining. Thank you so much for your questions. It's always fantastic to be with you and share some insights with you. And I really appreciate your time and that you subscribe and join. So thank you. Have a fantastic month, and I will see you all in a month's time. All the best.